It was the major banks who went to town on people that should have never owned mortgages across the board and across the world. This is probably more focused, and probably if SFB had better management and handled it directly, we might not even had it to the level that it had. But now that it's happened, it's put a damper on things. We're going to see regional banks be, if they don't choose to, the government will make them be much tighter, and they'll be watching them more closely than they might have been before. And the reason that's important is small to mid-sized businesses don't deal with the major fours. They deal with regional, local banks, and they deal from real estate to, business loans. So that will probably put a damper more on the economy. It'll be tougher. Lending won't be as loose as it might have been. And so in that regard, the banking crisis probably led to more of a potential recession than we might have had otherwise if the SVB and Credit Suisse and those things never happened. The Fed is, if you think about it, they had the pedal to the metal, Kool-Aid for everybody. And when things started to change, they said, well, there's really no inflation, and there was. And then when there was some, they said it's only transitory. And then suddenly they found themselves way behind the curve. And they had to hit the brakes. They had no choice. And unfortunately, we've had a multiple decades of cheap credit expansion, taking from the future by creating trillions of dollars of debt, but that helped accelerate the markets, and it made people get into investments in a way that they might have not been if things were tighter like they are now. And what was really concerning last Wednesday, while Powell was speaking about one thing, the Secretary Treasurer actually said the opposite. So they were clearly going into that not on the same page. I think by that evening, they were made to be on the same page. And Yellen came out the next day and walked back her comment. But I think the Federal Reserve still is in a corner. On one hand, there's no question that there's still significant inflation around. And at the other hand is, if they tighten too much, do they cause a recession, or are there other unknown factors out there? Like, people have not talked about, they talked about banks, but they haven't talked about pensions and insurance companies who face the same thing. They had the same losses on the paper. So I think the Fed is like saying their prayers at night before they're going to bed and hope by the next meeting it's more clearer which way we're moving than we are now. I've never been a believer of that because everybody is different. So at our planning group, we don't believe in they commonly call it a cookie cutter approach, but we don't have any set way. Everybody's an individual. In fact, if you need to talk to both the husband and wife, because when you talk to the husband, they say, yeah, I'm okay with 60-40. And then you meet the wife, no, it should be 40-60. And so I would just say that I think what you have to understand is the market is not going to be anywhere as easy as it was, or more of a one-way street that it was, for a whole lot of reasons. A, we're just not creating money out of thin air anymore. We're also at a point now, what I have called, and why I felt everybody should be out by the end of 2021, America's entered its worst ever social, political, and economic era. And it's just going to be far more challenging to make money in the stock market than it was perhaps the last 20 or 30 years. So I really think the older you are, particularly, and the less time you'd have to make up if there's any substantial losses, the more conservative you'd have to be. I guess that would be my cookie cutter approach in that regard. There's two things that are dead: globalization and the great credit expansion in the world. It's just can't keep going on the way it is. So I would just say that it would be more challenging for certain countries that were very dependent on flows from, because the market was really strong. But at the same time, I believe, and I don't want to take away a question you may have, but I believe the dollar has topped out. And therefore, if that's the case, that's actually somewhat beneficial to emerging markets. So net neutral. But I don't see any major country where I want to run and put a lot of money in at this time. The big signal is the massive amount, and I'm not skipping the goal, but just the massive action that central banks have taken. They're clearly one of the reasons they're buying this gold is diversify from the dollar. But the diversification from the dollar has other reasons too. America is no longer the most loved, welcome groups of people in the world. We've really from geopolitical factors, have much more challenging times ahead. Part of that is how we left the Afghanistan war. We left our allies to fend for themselves. And because of our own troubles within our own political system, and with the world looking to trade away from the dollar and the United States. There's pockets of the world, not just the BRIC nations, but other areas that are willing to trade and not use the dollar and not involve the United States. So all in all, plus with interest rates, I think have pretty well reached their peak. There may be one or two more raises if they think they can get away with it, but there's just no reason to think that the US dollar can go much higher anymore. When I sit in our planning group and talk to people, I say, I want you to own gold because I don't want it to go up. And they go, well, why would you want me to buy something that you don't think is going to go up? And my response is because if it does go up, and particularly substantially, where you have most of your money, financial assets, has probably gone down. So I think at the bare minimum, people should always look at gold for that reason. The same way we have car insurance and home insurance, we're not looking for them to burn down, but if they do, we want something to protect it. I personally have believed since the low 1600s that gold can make money from a capital appreciation. I do think, and I think both from a technical and fundamental reason, it is going to go to new highs in my view. And therefore, that has a substantial upside still, where I don't see that in general equity. So right now, gold should be first to hedge. And then also, I believe it can be played for capital appreciation. I've called this Congress to be the most dysfunctional we've ever had. The hatred, I mean, it's not dislike, it's hatred from both sides. And even within the parties, there's a fraction that leans more right or more left, depending on which party it is. So I'm not expecting any of the difficult things that need to be worked on here, first just for the country, let alone dealing with world issues, to happen. And I think the world looks at that too. I really believe the way we left Afghanistan really ticked off some of our better allies. We're also seeing at the same time of that happening, a unification of people that you would have never thought, most Saudi Arabia and Iran, led by China. China's over in Russia. China looks like it's leading a buildup of the BRIC nations. More nations are saying they want to join. In fact, the Saudis have talked about taking sales without dollars, both in rubles and possibly yen. And then they talked about possibly entering the BRIC nation as well. So, you know, I just think the United States here, it's a declining empire. It always happens. History always has it sooner or later. And the politics that we now have and is only making it worse. And so I expect that America will eventually see the dollar not as the reserve currency. I don't know if that'll be in my lifetime, but we're going to definitely see other types of trading agreements not using the dollar come into fashion and be regularly done in different parts of the world. My argument is the retirement crisis is the next big crisis in the United States. Most people know about the debt crisis. It'd be hard not to. But the retirement crisis, especially like we say with a large portion of Americans entering or hoping to enter that, we're at a real crisis now. Almost 75% of Americans now are working paycheck to paycheck. And they had to, in the last year or two, resort to using credit cards just to get necessities because the inflation costs. So they haven't had any opportunity and not likely to have an opportunity to save for retirement to reach an adequate level of what they think retirement should be. At the same time, the system that we have here is kind of broken. Social Security, it's basically heading towards insolvency unless they do a lot of things which aren't going to be beneficial to the people receiving it. And if I was under 50 years old, I wouldn't even think there'll ever be a time that I'll even collect it if I was. At the same time, Medicare, which is for our standpoint, when you're an adult, you hope that that's going to cover your ever-increasing medical costs. That's going to go up. And then there's going to be a battle of the ages. So 5 or 10 years from now, younger people who are going to be far more burdened tax-wise than when I was their age, they're going to be saying, wait a second, you're paying a couple $100,000 for some special operation for an 85-year-old, 90-year-old man? I don't think we should do that. Meanwhile, the 85 or 90-year-old person is going to say, well, I put all my money in, I want to live, I want to have this operation. And there's going to be a battle of the ages, and I'm not talking fisticuffs, but it'll be politically battle. And so when you look there, we're not alone. Japan is talking about by the year 2050, they're only going to have one person working for every retired person. That's unsustainable. That can't continue that way. They can't keep supporting it that way. So I don't think it's just here in the United States, but that's where I focus on. And I don't think people realize yet how difficult it's going to mean. And the things that are changing. To work into your 70s and 80s, you're just listen, I'm not too far from 70, okay? And I don't feel the same way as I did 40 or 50. And it's going to be a great challenge to see people in the 70s and 80s having to continue to work. And of course, they're going to look for government assistance. We have a huge problem with senior housing and low income housing in the United States. That's only going to get worse. So it's just one of many economic, social, and political problems that I think are so enormous that it's going to depress equity markets not to be the way that they were for the last 20, 30, or 40 years.